Hello, my name is Yasha and I help young men invest in the stock market. So in today's stock analysis, we are going to analyze Verizon Communications Incorporated with the stock ticker VZ. And as always, we are going to analyze it using this little Canva presentation that I have right now here. So let's begin, okay? If you are wondering whether Verizon is good stock or bad stock, or if you should sell or buy, or if you are just wondering how to analyze stocks, this video is perfect for you, okay? Now, first of all, why should you even listen to me? As you know, my name is Yasha and I help young men invest in the stock market. So if you are interested in that, when you have more trust for me, the first link in the description is for you, okay? Now let's begin with the actual analysis. This is going to be very beginner friendly, simple, with a lot of facts. Grab a piece of paper, grab a pen, write some things down because you will learn a lot. Now, if you are a complete beginner and you want to analyze stocks, this is the following that you should care about, okay? You should care about chart, profit, debt, money on the bank account, value, and price. Now, we are going to analyze exactly the same things for Verizon as well so that you can learn how to do it, okay? Now here you have some quick facts about Verizon. It's a telecommunication company that was founded in 1983 and it's a popular dividend stock. If you are a dividend investor like I am, then this might be also interesting for you, okay? Now here is immediately the first thing that you should pay attention to. Whenever you analyze stocks, you should analyze or at least invest in companies that are older or at least as old as possible, okay? For example, Verizon was founded in 1983. That means that it's already at least 20 years, or 40 years on the market. Now, why is this good? Because they survived quite a lot of crises so far, okay? Because the older the company is, the more crises it survived, and therefore, the higher the chances that they will also survive the next crisis. For example, Verizon survived the Black Friday, they survived dot-com bubble, they survived the real estate crash in 2008, and they survived coronavirus, okay? So at least 4 crises already, and they are still here. You know what I mean? So the older the company is, the higher the chance they have that they will also survive another future crisis. Because otherwise, if they survived already 4 of them, and they are still here, that's the proof, okay? But if you have some young company, for example, one startup that was founded 1 year ago, they have much higher chances that they will go broke in the next like stock crash, because they have not been tested yet, you know? They didn't experience any crisis yet. So for them, we don't know exactly how the management will react and how that company will manage the crisis, okay? But as I said, with this one, the older it is, the better it is, the more time tested it is, the more time proven it is, whatever, you know. You know what I mean, bro. I'm repeating myself way too much right now, but you know what I mean. Now we come to the chart, and for chart, we have an instruction that it has to grow for all 10 years. Now, what exactly does that mean? That means that I will draw a little exponential line, kinda like that, and we are going to compare the actual stock price chart, which is the orange line, with this black line, and preferably they should follow each other, okay? Because that means that the company is growing, that the company is more profitable, that they are expanding the business and just overall growing, okay? It's that simple. Now, does the chart follow, do the charts follow each other? No, they don't. As you can see, let me draw you. As you can see, up until around 2021, the company was actually growing, you know, the stock price was going up a bit, you know, but then it fell massively until almost last year when it started to grow again. So this is a bad sign, because we generally want to have a chart that grows kind of like that. Let me show you. A bit up and down, up and down, up and down, up and down, but in that direction, okay? And here we have exactly the opposite. Here we had quite a nice growth, and then it all fell down, okay? And now slowly up. So chart is not good enough, okay? Now we come to the net income, which is the same as profit. And instruction tells us that profit has to be in plus and it has to grow as well. Now here is the very same story. We will draw a little exponential line, kinda like that. And now we are going to compare the profit with that line, and preferably both profit and that line should grow exponentially, okay? Same story as with the chart. The more growing profit that the company has, the better it is, okay? Now here we have again quite some years that the company is growing and some years that it doesn't. So in my opinion, the profit is not good enough because it's way inconsistent. It goes up, down, up, down, up, down, up, down, up, down. So it's not growing like consistently, and this is generally a bad sign because we don't know what will then happen in the next years. We want to have a consistent growth because consistent growth is the more predictable one rather than this crazy one with ups and downs. So profit is also not good. Now we come to the debt, and for debt we have an instruction that it has to be low and preferably it should also decrease through the years, okay? Now what do we have here? Here we have a bit of a decreasing debt and then growing debt and decreasing debt, which is again a bad sign because companies are the same as you, okay? So if you have more and more debt, is that good or bad for you? Obviously bad, because you don't want to have more debt, because more debt means that it's more stressful for you to repay it back because you need to make more money, or even if you have money, then you have to spend much more of that money to repay the debt. You know what I mean? It's the same with companies. The more debt they have, generally the worse it is for them because it's much more harder, much more stressful. The higher the chance they have that they will do some silly decision which is not going to be rational but rather emotional, and then it's just going to fuck everything up. So whenever you analyze or at least invest in stocks, try to have stocks that have decreasing debt, and because those are mostly the safer choices, okay? Now here the debt, as you know, is increasing instead of decreasing, so that's a bad mark as well, okay? Now we come to the money, and for the money we have an instruction that money have to be higher than the costs, and here we also analyze literally the money that they have on their bank account, okay? This is the very same money that you have. For example, you have right now maybe 300, 400, 500 euros, and they have the very same money that we analyze. You know what I mean? Like they have $13 billion on their bank account. Let me show you. They have $13 billion, which is the very same money that you have on your bank account as well, just higher, okay? Now, is that good or bad? Think about yourself. Is it good for you that you have money on your bank account? Of course it is. And now here is the very same thing. For the company, it's way better that they have more money on the bank account because that might be used to cover some unexpected events, okay? For example, there is one crisis that might happen, so they have $13 billion to cover the potential costs of that. You know what I mean? So yeah, it's that simple. I don't know what to say here, it's that simple. The more money they have, the better it is, okay? So here we are happy. They have 13 billions, that's more than enough money. And now we come to the valuation, and obviously we want to invest in stocks that are undervalued, okay? Now how do we measure valuation? By two things. First thing is called P/E ratio, and the second thing is called intrinsic value, okay? Now, as a complete beginner, those two expressions might sound a bit complicated for you, but don't worry, they are very simple, okay? Now, P/E ratio is actually used to compare the earnings of Verizon with the competitors and overall stock market, okay? Now, P/E ratio should always be lower than 15. Now, why exactly 15? Generally, the stock market as a whole place has P/E ratio of 15, okay? And whenever we analyze and invest in stocks, we want to invest in companies that have P/E below the stock market because that means that they are undervalued, okay? Now, how is the P/E ratio of Verizon? It's around 15, which is just slightly more than it should have been. So here it's kinda okay. The Verizon is fairly valued in terms of the P/E ratio, okay? You can find both P/E ratio and intrinsic value on the internet. You just write in Google P/E ratio Verizon and intrinsic value Verizon and you find the data, okay? And now we come to the intrinsic value, which should be higher than the current stock price. Now, what exactly does that mean? So, based on some calculations of the financials of Verizon, the fair price should be $58, okay? Verizon should be right now priced $58 per stock, but the actual stock price is $41. That means that it's around $20 more or less below of what it should have been. You know what I mean? So intrinsic value tells you the price that the Verizon should have at this exact moment, should have, but the current stock price tells you the price that they have, you know? And intrinsic value should be higher than the current stock price, which is the case right now here, in order for stock to be undervalued. Now, here we obviously have intrinsic value by around $20 higher than the stock price, which means that the Verizon is actually undervalued stock with potential to grow, okay? And now we come to the price, and for price we have an instruction that price has to be lower than 150 euros. I'm from Europe, I use euros. You're from America, you use dollars, okay? So for you it's the same. Below $150 is the good price to buy the stock, okay? Why exactly 150? This is kind of the limit that I set for myself because I want to personally invest in cheap stocks. Whenever you have a budget, for example, you are a young man and you probably have a tight budget of, I don't know, $500. If you buy one stock that costs $400, what are you going to do with the remaining 100? Or what are you going to do with just that one stock in your portfolio? You know what I mean? So whenever you analyze or invest in the stock market, try to buy stocks that are cheap because that way you can diversify your portfolio, okay? I personally like to buy stocks at the moment that cost between 30 to 50, maximum $100, okay? Because that allows me to invest more money into those different stocks and I can diversify and it's just better, okay? It's better protection for your own money. Now, current price of Verizon is $41 around, so it's way below 150, so that's a good sign for us, okay? Now we come to the final evaluation where we are just going to summarize everything that we found out about this company so far, okay? Now, does the chart grow exponentially? No, it doesn't. If you don't believe me, go watch the whole video again, okay? The chart is first kind of staying on the same level and then it fell massively, okay? So that's a bad sign for us. Does the profit grow exponentially? No, it doesn't. It grows unpredictably, it grows inconsistently, which is what we don't want to see, okay? Does the debt decrease? No, it doesn't. Do they have money in the bank account? Yes, they do. They have 13 billions, which is amazing. Is the Verizon stock undervalued? Yes, it is. And is the price below $150? Yes, it is. Now, should you buy Verizon or sell it? In my opinion, bro, you should sell it, and I will tell you why. You should sell it because the growth of the price chart was completely fucked up, okay? You can see that first it was kind of the same and then it fell down massively, which is a bad sign for us, you know? Additionally, the debt is increasing and net profit, which is net income, sorry, which is basically the profit, is also completely inconsistent. We don't want to see that at all, okay? Now, if we come here to the more detailed analysis, you can see that the stock is actually quite good, you know. They are reinvesting more and more money into the company, which shows this graph right now here. Then debt is decreasing, so that's a good sign, but it's still extremely high for our own measurements, you know. then profitability is actually decreasing, as you can see right now here in this chart. And those are basically the points why I wouldn't invest in this stock. Okay, it's a bit inconsistent, the profitability is decreasing, so we will only see what will happen in the future. Okay, and I personally also don't like to invest in telecommunication stocks, because when you think about telecommunications, it doesn't sound like one field or one niche that might be profitable, you know. So for me, that's already a no-go, you know. So yeah, if you want to know more about stock market investing, when you have more trust for me, the first link in description is for you. If you want to see more content like that, you know, click subscribe, join me on this amazing journey to become a millionaire with stock market investing. Do the hard work and see you on top of the world.